Hello, everyone. You're listening to the Small Business Shows. My name is Swire Ho, your host for the show. My guest today is Chris Larsen. He's the founder and principal of Next Level Income. Chris has been investing in and managing real estate for over 20 years. While still a college student, he bought his first rental property at age 21. From there on, Chris expanded into developing, private lending, and buying distressed debts as commercial office, and ultimately synchronizing commercial commercial properties. I'll let Chris talk more about his concept, but before that, welcome to the show.
Thanks, Wire. Great to see you.
Chris, I'd love to learn more about how you get started with the first investment property. And
Yeah.
until this point right now, what do you like about what you're doing?
Yeah. So I appreciate it, Swire. And if anybody's interested in learning about kind of a little bit more about my story in depth, you can get a free copy of my book at nextlevelincome.com. You can click on the book link there. But long story short, I bought my first property at 21. All I wanted to do in college was race bicycles. And I was racing bicycles. My best friend died between my freshman and sophomore years, and I raced another year. And I'm kind of riding around during a race, and I thought, this isn't really what I should be doing. There's more to life than this. And I came back to school after that summer. I quit cycling, and I said, all right, I don't want to have any regrets. I want to live life on my own terms. And the fact of the matter is, we have to have money to do that, right? Whether you want to expand your business, whether you want to go on a vacation, whether you want to donate time. And I said, all right, I need to figure out how to become financially independent. And my first choice was the stock market, which during the late 90s was on a tear. It was very volatile. And after several sleepless nights, I decided, you know what, there's got to be a better way. I read over 250 business, finance, investing books, and I decided to buy that first piece of real estate. So bought that piece of real estate, and from there, built up a portfolio and really focused on expanding our passive income to the point that we could rely on that, and then really make choices on our own terms after that.
Thanks for sharing, Chris.
Yeah.
So I wanted to focus, and I know, especially, you are an expert for the infinite banking concept. For those of us who have not yet heard about the term, what is it and what does that do?
Yeah. So infinite banking, this concept of becoming your own banker, which Nelson Nash pioneered several decades ago. I think it's an awesome concept because it can be used by real estate investors. It can be used by business owners. It can just be used by anyone that wants to have a little bit more financial security during any point in time. I was licensed as an insurance agent going back over 20 years. I got relicensed during COVID, specifically to help educate investors and business owners on this concept. And what it is, Swire, is it's a specific type of insurance contract, typically using overfunded or max funded cash value life insurance. And the best way to think about it for a business owner, I think, is it's basically a private pension. So you can fund these policies in a very tax efficient manner. They grow at a very predictable rate, much like a pension. So typically they're growing 5 to 6% a year in a very tax efficient manner. They have some degree of protection from the insurance. Typically that's a pretty large insurance policy, usually 7 figures for people that are, middle age, fairly young, fairly healthy. And, that cash value can accumulate over time. What we talk about with basically our investment optimizers, what we call it, which is in the banking portion of our website at nextlevelincome.com, talks about how to use the cash value to fund investments and really supercharge these policies and the growth within these policies.
Well, that's really a fun concept, and especially as a small business owner or entrepreneur, at some point you might need the help from a bank. And then
Yes.
whenever, I don't know if everyone will agree with me, when
Yeah.
you talk to a banker, you always not making enough money. You don't have enough assets. And then whatever that you're trying to do, maybe wait another 3 to 5 years and come back. So this actually
Yeah.
can benefit, people who need that cash. And then it's actually
Absolutely.
your own cash.
Absolutely. I'll tell you a couple quick stories here. So one, my wife and I owned our lot. We were building our house. We had no debt. Credit scores over 800, right? Sounds like we should be pretty insurable, right? Or pretty lendable, right? We go to the bank and the bank says, oh, yeah, we got a problem. You're self-employed. And I said, yeah, but I I work for this other company too. So I had a couple different sources of income. Oh yeah, but you haven't worked for them very long, only a few months. I said, oh, actually, the company was acquired, so I work directly for the parent company now. Look, I have this nice letter, and it says that I have the same role, the same compensation plan. Actually, it's even better benefits. So, and they said that's a different employer. But Chris, because you're such a great banking partner with us, instead of waiting a year to get a loan for your house, we're going to waive that, and it's only going to be 6 months. And I said, you got to be crazy. I was like, is this? I thought it was a joke. So it is amazing, if you're not really, you don't conform to the bank's lending standards. You don't have a W-2 job. Maybe you don't have enough debt. Sometimes it's wild. You need this money. Also during COVID. So our two main businesses during COVID were real estate. There was an eviction moratorium. Basically, that's hey, you don't have to pay rent and we can't kick you out. And our other business in the medical device industry, all the cases canceled in the hospitals for weeks. And I turned to my wife, and we were building the house that we had at that point gotten a loan for. And I said, I don't know if we're going to have any money coming in this quarter, maybe not next quarter. And all I had to do was move money out of our insurance policies into our bank accounts. And I had a year's worth of cash there ready to go. And that was very comforting to be able to do that.
But then that's something that you have to pay back over time, right? So, that's, in terms of a loan, but then obviously you are your own bank, paying yourself back.
Great question. And you said, it's kind of this becoming your own banker. So a loan from a bank to you is an asset to the bank, right? So what's nice is if you're the bank, you have the loan, the liability. Sorry, I'm not good with being in a mirror here. We have the loan or the liability, and we have the asset, right? So essentially, they cancel each other out. So you might have seen me smiling when you said you have to pay the loan back. I think you should pay the loan back, and the reason I say that is because we should be using this money typically for capital investments that are going to generate a return and should pay the loan back in itself. But the fact of the matter is, if it's your money, you actually don't have to pay these loans back ever because they're covered by the collateral, which is typically the insurance policy itself. So the bottom line is there's tremendous amount of flexibility when it comes to this. So for a business owner, you should be disciplined. You should have a plan to pay yourself back, which is how you continue to grow that money and your assets. But let's say you have a lean month, a lean quarter, you can defer loan payments. You can not pay that, or you can even utilize it, as I mentioned, kind of as a private pension into your retirement years, and you can pull that money out as a loan, and you actually don't have to pay tax on that at that point. So it's a very tax efficient way. And I'm kind of getting into some more advanced concepts, but the bottom line is very flexible when it comes to how you utilize these loans.
Are they somewhat liquid? Can you withdraw them as needed? Because, I'm thinking, speaking again for myself now, there are
Yeah.
incidents that, we take on a larger job than normally would, and then we need that cash flow maybe just for 60 days. We need to
Yeah.
pay our vendors and wait until the project is finished, and then, we can pay it back. So is it
Yes.
somewhat liquid?
Very liquid. So here's the nice thing. When you take a loan, and it technically is a loan that you're taking, that loan, there's no one that approves that loan. It's your money. It's your cash. So I can move that money literally from one account to the other the way we utilize them. If you go direct to the insurance company, it may take up to 5 days to get that cash, but there's certain things you can put in place. So for instance, we have 4 of these types of policies, my wife and I. And we pull all those policies up underneath one single business line of credit. So I can access that line of credit, which is collateralized by all 4 of those policies at any time. And I don't have to worry about, do I take it out of this policy or that policy? And I can pay it back or not pay it back at any time. And I have it linked kind of to our investments, which is our business, right? Our real estate investments. So as cash comes in, I'm able to kind of pay down that line of credit or expand our line of credit over time, and kind of make decisions based upon what our cash flow is on a annual as well as a quarterly basis.
So what you're saying, when your situation changes or maybe you expand, right? You fortunately grow your business enough, you can actually add more policies in there to fit whatever cash flow you'll be anticipating, when you get bigger.
Yes, and that's a great point. This is something we don't always talk about, Swire, but one of the big problems or big challenges that I see, some of our clients and investors have is that they say, "Oh, like I don't want to be locked into paying these policies," and we typically um, have them with, say, a 7-year paid up period. So you say, "Hey, we have some predictability. Where after 7 years, these policies are basically 100% funded or self-funding. They're kind of self-sustaining at that point." But one of the problems is you can only put so much money into these policies because the government, the IRS, limits how much money you can put into them because they used to be used as tax shelters. So back in the 80s, you could just dump tons and tons of cash into these policies and just use them as a tax shelter. So government limits how much you can put in there. So that tells you how great of an option they are. But the good news is if you're still healthy, if you're insurable, you can do more policies if you want to expand kind of your family bank, if you will, or you can do policies that are on other members of your family. So, Swire may own a policy on his, partner, his spouse, business partners, children, and even if you own them, you can roll those up and still use this concept regardless. So if you're listening saying, "Oh, I'm not insurable, I'm too old, I have a health issue," you can still use this concept. There's ways to do that, and actually own the policy yourself. There's if you're working with the right agent, they can kind of walk through all this and make sure that you have the right fit for you.
Is this something for a small business owner? Is this something that they personally would pay, or their company take out that policy for them?
Yeah, you're asking all the right questions, Swire. These are great, and it's important to note that my answers might not be like the only answer. So there's
Mhm.
different answers for different people. One of the nice things about insurance is it's kind of like a Roth IRA. Sometimes I call these policies Roth IRAs for rich people because you put the money in after tax, which means your proceeds from these policies are tax free. And I mentioned earlier, there's even ways to get the cash out tax free, even if it's grown higher than the amount you've put in. If you put it in pre-tax through your business, which you certainly have the option to do, there's ways to set that up. Those proceeds may be taxable. So you just have to kind of weigh the balance of that. And it's just like, it's just like using a qualified plan. You may say, "Hey, I'm going to defer paying tax. I'm going to put it into an IRA or a SEP or a 401k." But at some point in the future, the government's going to say, "All right, time to pay up." Do that. So you kind of decide, do you pay today? Do you pay tax today? Do you pay tax in the future? It all depends on your situation, your business situation, that sort of thing.
That's very interesting. And Chris, do you really, know the experience and how do you get that? At what point did it occur to you that this is something that is available to you and it's actually
Yeah.
something that you can use to your own advantage?
Yeah. Yeah. So unfortunately, and this is why I do almost everything I do, Swire. Like I wrote my book. It's like, hey, if you're listening, I want to help you figure it out faster than I did. So we started these policies, my wife and I, right before my first son was born. He'll be celebrating his 13th birthday here very shortly. So over 13 years ago. And the original idea was we were just going to put money aside so that we could use the cash value of these policies to pay for their college education, both my son's college education. I said his, but both two boys now. And then we also used the cash value for things like buying cars. So instead of taking out a loan, we would use cash, we'd pay ourselves back. And then if I got like a big bonus check, I was in a sales role, I'd put some cash in there. Well, we started building spec homes about 10 years ago, and I talked to my agent about it. And he said something interesting after we'd been doing it for a couple of years. He goes, "Man, Chris, I love what you're doing. I wish all my clients would do what you're doing." And it dawned on me that I had to figure that out myself. And he didn't really educate me on the options with these policies, even though he knew what I was doing. So I got frustrated. And when I get frustrated, I go search for answers because I'm a problem solver. So I went out, I did research. I came up with what I thought were some good answers for this and some good resources. And I ended up meeting my current partners with Money Insights, and they're business owners. They are insurance brokers, so they don't work with just one company, and they work with a lot of investors. I worked with doctors for most of my career in the medical device industry. So they work with a lot of doctors as well. So it really didn't dawn on me, Swire, unfortunately, until about 5 years ago. But at that point, I said, "All right, we're gonna fix this problem." That's why I got relicensed, and that's why we have the resources we do now. So on the banking link at our website, You can actually check out a video. We have a white paper up there, and we even have something concept we call the passive income operating system, where we tie all these concepts together, and we kind of show how you can use the cash flow through your business or even your W-2 income, if you have it, to really optimize your cash flow in your own system. So it's kind of like running your life as a business when it comes to cash flow.
Yeah, thank you so much for sharing. Like
Yeah.
the solutions always comes when we actually have that problem ourselves. And I really like that
Indeed.
story because depending
Yeah.
on who you talk to, it might not be in their own interest, or maybe they
Yeah.
are trying. They have
Yeah.
another product or service that they offer. So that's
Yeah.
why maybe they didn't mention that. And
Yeah.
then and you took that and into your own hand and actually research and find
Yeah.
the solution that you're looking for.
Yeah. Well, and it is interesting because the industry, it's not really aligned perfectly with this concept, and the reason is when you structure these policies this way, you're actually minimizing the insurance. And you do that because you're minimizing the cost and you're maximizing the cash value. And that actually minimizes the commissions that are paid out to the agents.
Hmm.
So there's a little bit of a backwards financial motivation. So just your average agent that's out there, life insurance agent that's out there, one, their company may not be able to do it because you have to be with the right kind of companies. And two, they're not really incentivized to do it. So it's hard to kind of find the right professionals, which is why I said when I found my partners at Money Insights, I said, hey, these guys, they know how to do it. This is kind of how they structured their business and do it this way. But for me, it's a concept and it is a tool. It's not for everybody. It's not for everybody. But if you have a business, if you're an investor, then it can be a very powerful tool that basically pays for itself. It's really cool.
What other questions have
Yeah.
you encountered from entrepreneur
Yeah.
and from small business professional
Yeah.
about this infinite banking concept?
Yeah, so some of the frequent questions we get are, well, is this expensive? Like, you say it basically pays for itself. If you're a business owner, you understand there's startup costs when you do something like this. So typically these policies, you're going to pay in the first 2 years, you're going to pay a portion of your premiums, your premium payments that are going into the policies. They're going to cover those startup costs and the cost of the insurance to do that. And what I like to do is look at that cost and say, hey, if it's going to cost you $20,000 to start these policies, but you're going to have this for really for the rest of your life, that then you can make a decision whether or not that makes sense for you. One of the comments I get is, Chris, I've heard this isn't a great investment. I don't look at this like an investment. You've heard me call it a tool a couple times. It's a tool. And if you look at it like an investment, then you have to consider, well, what if, like my best friend, his wife died after 3 years of having their insurance policy. You wouldn't ask him what was your return on your wife's life insurance policy when she died. Some people might. They might want to know that. But the fact of the matter is, he saw it as a tool, as protection for his family. And I know he doesn't have his financial calculator going out there, and he's not saying, oh, this was a really good investment. It was a good choice for him. It was a good tool. So I think we have to be careful not to look at it, like an investment. This is a piece of the financial puzzle and a piece of your financial foundation, but I wouldn't put it in the same category as, stocks, bonds, those sorts of things. And that's the other piece. There are different types of insurance products that are linked to the stock market. I wouldn't combine these strategies. This would, in my mind, is used specifically with regular whole life insurance that has a predictable payment. So if you want to borrow money out, you don't have a variable payment that's going up and down. So you have some predictability. So essentially, what your cost of capital is. So then you can say, hey, if my cost of capital is 5% and I want to fund a project that's going to return 10, 20, 50% in my business or other investment, then you can make that choice in a very educated fashion.
Yeah, I really like that you said it as a tool because it's a tool that like you said, if your risk is 3%, for example, and then you're
Yeah.
able to grow this for 25%, so you do that every day, all
Yeah.
day, and
Yeah.
then this is
Right.
also, I think, in the entrepreneur journey, maybe in the beginning there are options out there or there are tools out there that are
Yeah.
not yet available to you, but then when you hit a certain key point, when you're having employees, then you could structure for the retirement plan, the
Yes.
retention package. So yes, it's won't be available to you when you first started out, but as you go on with your entrepreneur journey, these are something that you looked at, and something that you should be aware when you pass a certain point.
That's exactly right. Yeah, great point. And you can these concepts scale, right? So you can start smaller policies like we did that may fund a child's college education, or that cash may be there as an emergency fund. I talk about that in my book, where we basically use the cash value for an emergency fund. Then we used it to buy cars. Then we used it for our kids' college education. Then we used it for business expenses investment options that were out there. And now it's a real central portion. And kind of, if you go even more advanced, you can actually start to do generational wealth planning, where you can use these policies to fund future policies on multiple generations and create, 8, 9, 10-figure legacies. So if you have a business out there, what other tool can you use to predictably create that kind of legacy for your family? It's pretty impressive what you can do if you plan properly.
Yeah, that's kind of going over my head right now. Trying to plan
Yeah, I
for
mean,
it.
it is pretty mind blowing when you kind of look at it. And we did a podcast with Rod and Christian, my partners, kind of talking about generational planning because as you get into that, you want to leave a legacy. It's something you can, again, like we haven't set those up specifically ourselves, but I'm kind of using that as an example of, even though we're using the concepts in a quite advanced fashion, we still have further to go with these concepts that we can use, and we can multiply or impact by another factor of, say, 10.
So let me ask you, the scenario that you would plan out. For example,
Yeah.
I know that a lot of small business, because we might have a line of credit, right?
Yes. Yep.
From the bank, or we have cash parked in like a money market, right, in a bank, so we
Yes.
could access this quickly. So
Yeah.
depending on where we are, you actually suggest that the business might look at a policy either from the business side or from the personal side, so they don't just have the money idle, over there, and then you can actually structure it to create your own infinite banking concept.
Yes. So let's talk about quickly 3 different scenarios. So scenario 1, let's say you keep $50,000. Maybe you're a W-2 employee, maybe you're a small business owner, but you say, hey, I like to keep $50,000 of cash just for my personal emergency fund for, say, a year's worth of basic expenses. You could look at the cost of a policy, and you could actually use some of that cash to fund those policies, and then grow your cash value to 50,000 or more in those policies. And now what's nice is it's not just sitting in a bank account or money market account, as you mentioned, Swire. It's actually there in case something happens to you. There's protection, right? If something happened to you, and you have the cash value, which you don't want to touch the cash value because it's your emergency fund. Scenario number 2, let's say that's not just your emergency fund. It's your working capital fund for your business that you dip into in and out of to kind of smooth cash flows. And that could even be like I did when I was a sales rep. So let's say my target income was $300,000 for my business or as a sales rep. But I said, well, we're only going to live on half of that because, I have variable compensation. 1 year I might make 150, 1 year I might make 450. Now on average it's 300. Well, what do I do with that cash? I can put that cash into the policies. I can take it out if needed, or if I have an expense, I can kind of use that to smooth my cash flows. And then the last one is, let's say, like a friend of mine, he has a large business. He needs to keep $2 million liquid for collateral. You can even use this concept and use, something like that, like 7 figures of liquidity, which you can put into a concept, or into a specific type of policy that's going to give you access to that capital. But it's not just sitting there doing nothing for 1, 2, 5, 10 years. When right now inflation is, say, double digits, that's rough to see that type of capital sitting there just getting eaten away.
Yeah, I think that's very interesting, especially the last scenario, because it is required that you have some type of bank or access to capital before you can bid on a certain project. I'm sure that I've seen those myself, and some of it actually we're not there yet. So it's nice to know that you can actually structure it yourself. So when the time comes, you have that available, and you don't have to knock on doors and talk to like 10 different banks just to get what you needed.
Yeah, no, exactly. And again, this most people listening are business owners. So there is a startup period, there is time, there is cost, there is thought that goes into it. But if you have a successful business and you're planning, you can align the size of your policies and your premiums with your cash flows in a predictable fashion. So you can give yourself more predictability. You can give yourself immediate protection. You can multiply your net worth almost instantaneously with the death benefit. And again, you can use it in a very simple fashion, or you can also, start to use some of these more advanced concepts like we've talked about today.
So it will be the policy will be in place, if you pay for it, obviously, and
Yep.
then or it terminated because of death. So like they couldn't just cancel you, like sometimes line of credit does from a bank.
So if you stop paying in your policy, just like your car insurance, it's going to be canceled.
Right.
Now, you have a period where it lapses. And that's the thing. What I would say is if you're looking at these policies, you probably know how much premium you're going to put in for the first couple of years until you kind of accumulate a specific amount of cash value. So you might set that money aside. We're talking about the example of somebody with an emergency fund. You might use that emergency fund to fund these premiums. But then the nice thing is you can actually use loans from your policy to pay your premiums. Now, people might say, Chris, that's crazy. Why would you want to do that? Well, let me give you an example. Let's say my premium for a year is $100,000. Now, that might sound crazy to some people to think you're putting $100,000 in. But after you start these policies up, you put $100,000 in, you have $100,000 of cash value. Okay. So I have $100,000 of cash value if I put $100,000 in. If it costs me 5% to borrow that money, but my policies are returning 5 or 6%, why wouldn't I put it in as soon as possible to get that money compounding? And then let's say I have that cash coming in over the course of a year, I can pay down that loan or that line of credit over the course of the year. So my money's growing in an exponential fashion, which is what we talk about in the white paper on our website. And I'm paying down the policy based upon simple interest. So I'm knocking down that payment. And that's really, you're taking the magic of compound interest. And it's just like, think about owning a property or a house. Your mortgage stays flat, the value of the property increases, and those increases compound as the value of the property increases, right? So if your property increases 5% a year and it goes from 500,000 to $1 million, well, now 5% on $1 million is $50,000. That's a significant increase. That's like 10% on your original $500,000 value. Whereas your mortgage payment, maybe it started out at $400,000 on that $500,000 property. By the time your property is worth $1 million, you might only owe $250,000 on your mortgage. And that's the same type of concept because you're putting a specific period of time with your premium payments. The money grows in a compound fashion, like a piece of real estate, and you're paying down your premiums just like you're paying down a mortgage.
I think this episode is a timely episode because of where we are heading with our interest rate. I don't even want to know what your borrow rate will be when you go to the bank right now.
Yeah, and that's the other thing. It's typically on an annualized basis what you can borrow borrow the money from your policies, which is really nice. And the problem is, as most of us have faced that have been in business for a period of time, when the great financial crisis happened or Great Recession happened, I lost all the lines of credit on my properties, all the lines of credit. The banks, it didn't matter how much the interest rate was because they wouldn't lend to me at all. Mm-hmm. So it's very nice to have the predictability to lend, in addition to typically a much more predictable rate of interest. So it's a tool that I'm very fond of. And I'll add this last point. My father passed away when I was 5. So it's something that I'm very acutely aware of the value in my life. So my, probably my situation may be a little different than some people's situation because, I've experienced that loss.
Sorry to hear that, Chris. But I really do enjoy you sharing all this information today. And this is definitely a great tool for some of us to consider. And I can probably ask you more questions in the next 2 hours, but I think listeners who have personalized questions for you should definitely reach out to you. So what would be a good way, and what can we learn more about what you do?
Yeah. So, to help you out, to save time, go to our website, nextlevelincome.com. And if you click on the banking link, you're going to get to see, it's like a 25-minute little mini webinar that's on there and also a white paper. So if you're like me and you like to read, instead of watch or listen, you can read that very quickly and have that in your hands to kind of walk through some of these concepts. Also, oh, thank you, Squire. You put up a link here on the website. And we're going to give a special code to anybody listening. The code is very easy, SBS for Small Business Show. If you go to this link, that's going to save you 30% off our course. And our course is going to walk you through steps in how to make more money in your career or your business, concepts like the investment optimizer, our passive income operating system, tax strategies to help you save money, whether you're a W-2 earner or a small business owner. Good news, if you're a small business owner, you have even more options to save taxes, estate planning. And then the final piece is how to grow your money. So let's say you're a successful business owner and you're like, Chris, I'm spending off a ton of cash. What do I do with it? We talk about active, passive real estate options. And we even have a beautiful spreadsheet in there that you can plug your numbers in and see when your passive income will exceed your living expenses. And that's all at that link right there. Again, it's going to be code SBS. You'll save 30% off on that course.
If you're listening, I'll drop the show, drop it on the show notes so you can take advantage of that. Chris, thank you so much for coming on today. I learned a lot.
Oh, it's been a blast, Squire. Great questions. It's a pleasure to see you again.
Take care.